JEPI and QYLD. These are two of the most utilized covered call ETFs out there. They're both used to generate income, but in my opinion, one of them is a wealth builder and the other is a liquidation machine. I've analyzed the 2026 total returns, and the results are shocking. So while one fund is actually growing your account, the other is quietly selling off your future just to keep the lights on. If you're chasing the higher yield without looking at the NAV, you're walking straight into a right hook. Here's the truth about these covered call giants. And by the way, if you're new to the channel, I wanted to welcome you. This channel is going to be focused strictly on covered call ETFs. Number one, because they're getting a lot of notoriety. And number two, there's a lot of misinformation out there that I'm hoping will lead you in the right direction as we discuss and analyze different covered call ETFs. So one thing I did is I went to this website called etfcentral.com, which is available to you as well. I highly recommend you take a look at it, whether you invest in JEPI or QYLD or some other covered call ETFs, to compare between two ETFs that you're considering buying. And what I'm going to do is look at the data that is presented here so that you can make a fair decision as to which one is best for you. As I'm recording this is January 21st, 2026. By the time this YouTube video comes out, it's going to be the 22nd. And looking at the price of 58 versus 17, that's a big difference in terms of what you're going to be able to acquire, how many shares. But take a look at the assets under management. Over 42 billion with a B for JEPI compared to over 8 billion for QYLD. Now, the expense ratio for JEPI is almost half that of QYLD, the cost of admittance, if you will. The other thing I wanted to mention is that JEPI is leading in 2026 because of investor sentiment. Looking at the site, JEPI has seen a massive inflow of 270 million year to date, whereas QYLD has seen negative flows of 3 million, and that is suggesting investors are fleeing for more stable total returns. The performance thus far in the early weeks of 2026, JEPI has outperformed QYLD by over 2% in total return. Looking at the strategic differences now between JEPI and QYLD, first, the management style. JEPI is actively managed by JP Morgan, and it allows it to select specific low volatility stocks and write options tactically. QYLD follows a passive rules-based strategy that blindly sells at-the-money call options on the NASDAQ 100 index. Looking at the sector exposure, JEPI is more diversified. It focuses on IT, healthcare, industrials, whereas QYLD is heavily concentrated in the NASDAQ 100. Not saying this is bad necessarily, but it does make it more sensitive to tech sector swings. And finally, when it comes to wealth building versus income, JEPI seeks a balance of income and capital appreciation, whereas QYLD is often criticized as a liquidation machine because its high dividend yield often comes at the cost of its share price or NAV eroding over time. Now, before I go further, I do want to put out a disclaimer that nothing in this channel is financial advice. This is strictly for education purposes only. Investing, of course, comes with risk, including loss of capital. And as always, please consult a financial professional before making any investments. And I'm not suggesting you purchase JEPI or QYLD. The purpose of this video and subsequent videos is simply to provide you with an education to help you navigate the complexities of covered call ETFs. Thank you so much. One more thing I wanted to cover is the net asset value, or NAV. If you look at the current NAV for JEPI, it's 58.38, and the market price is 57.62. What does that mean? It means you're getting JEPI at a discount. If you look now at QYLD, as you can see from here, it's actually trading at a premium. Looking further at JEPI, this is the calculated JAB. Unlike QYLD, JEPI is actively managed. What I mean by that is they don't blindly sell options. They pick 100, give or take, low volatility stocks like Progressive or Train Technologies. But you know what the secret sauce is? ELNs, or equity linked notes. So these are custom made black box contracts that allow JP Morgan to generate income while keeping the share price stable. In 2026, JEPI has managed to capture the market's upside while its drawdown was 30% less than QYLD's. And that's the difference between a fighter that just swings wildly and a pro who knows how to block. The bottom line, JEPI protects your principal so your income is actually compounding. Now, the next section is going to be a little boring, and that's taxes. We cannot get away from them, right? And looking at QYLD's distributions, it's often return of capital, which sounds good until you realize it actually lowers your cost basis and sets you up for a pretty massive tax bill later, or worse, indicates the fund is cannibalizing itself. JEPI's structure is designed for efficiency. So if you're holding this in a taxable account, the higher yield of QYLD might actually leave you with less cash after the IRS takes its cut. So please always look at the net after tax yield, not the headline number. And definitely, as well, like I said before, consult with a professional, in this case, a CPA. So which one wins the showdown? Well, I would say if you're, for example, 85 years old and you truly don't care if your portfolio hits zero, as long as you get a check this month, maybe QYLD is for you. But for everybody else, and again, this is my opinion, JEPI is the undisputed champion. It gives you the income you want without destroying the wealth you've spent years building. In fact, there's a third option that's actually outperforming both of them right now, but I'm going to cover that in an upcoming video. So what do you think? Do you agree with this assessment? Do you currently own JEPI or QYLD, or maybe both? Would love to hear your comments. Please hit the like and subscribe button, and I will see you on the very next episode. Have a great and prosperous day.